A lot of people insist you have to invest in real estate. That is how people get wealthy. But you know, there's another vocal crowd, and they say, no. You're not going to beat the market. Don't even try. Just put your money in low-cost, passive index funds. And that's how you're going to get wealthy. So what's the truth? I've been a financial advisor for over 20 years. And in today's video, I'm going to share with you what I view as the pros and cons of each and help you make the decision what's best for you. So let's just jump in. Let's start with the index funds. So as I said earlier, the big argument there is you can't beat the market. Just get the market return and you'll be fine. Is that true? First off, what is the market return, right? There's all kinds of markets. There's the S&P 500, there's the Dow Jones, there are the housing industry ETFs, there are ETFs that track biotechs, there's ETFs that track small cap companies, large cap companies, growth companies, value companies. So just saying index fund is not sufficient. But one of the nice things about the index fund investing is once you decide how you're going to invest, that can be a pretty passive thing. And the pundits are right. You know, if you invest, let's say your goal is to beat the S&P 500. I don't think it should be. I think your goal should be to meet your financial objectives. That's really why we're doing this, right? Who cares what the S&P 500 does? What I care is what your financial goals are and how do we get you to your financial goals while taking as little risk as possible. However, that said, if the way you're going to judge yourself is, did I beat the S&P 500? You know what? I would say for a lot of folks, if that's what you think is important, again, I don't think it should be, but just buy the S&P 500, right? And then you don't have to worry about, you know, how did I do compared to the S&P 500? But that's a risky strategy. It feels low risk right now because the S&P 500, which is an index of the largest 500 publicly traded companies in the United States, it's market weighted. So it's not like each company in there is 1/500th of the S&P 500. You can get that. That's called an equal weighted S&P 500 index. But the normal S&P 500 that we all hear on the news every night, that's market weighted. So companies like Apple, companies like NVIDIA, companies like Microsoft, because they're quite a bit bigger, represent a much larger percent of the S&P 500. Therein lies one of the problems. You might think you're getting exposure to 500 companies, but look up what percent the top 5 companies are of the S&P 500. And I think it's going to take your breath away. I won't spoil it for you, but it's definitely more than 10%. So look it up. It's enough that you say, I'm not sure I want to have that much money exposed to just 5 or 7 companies. Okay, so yes, you're going to get the market return of that index, less fees. So that's a pro. Another pro is the fees tend to be pretty reasonable. It's pretty competitive as long as you're dealing with a financial advisor or a company where they're not getting commissions. Once you start dealing with a company that's getting commissions, just be careful. There are good people that work for those firms, but remember, they have an incentive to sell you something that gets higher, that pays them a higher commission. So there might be an index fund that they could offer you for 1/20th of 1%, but they don't make any money if they sell that to you. There could be a similar index fund that instead of 1/20th of 1%, charges you 1/4 of 1%. And they get a little bit of money. Maybe they get 1/10 of 1% every year for as long as you own it. You know, how aggressively are they going to tell you, hey, you know, there's this one over here for 1/20th of 1%. You're actually paying 5 times as much for this one that's at 1/5 of 1%. Is that right? Maybe 4 times. But you get the idea. So the person you're dealing with, the company that you're dealing with is important. And you could be locked into these investments. Not all index funds are created the same. Some index funds are hard to sell. You might not be able to move that from a custodian. So you might not be able to move that into a Charles Schwab, into a Fidelity, into a Vanguard, which at that point you might have to sell that position and trigger taxes. So you want to be careful. Another thing you want to be careful of is with an index fund, the nice thing is it's not active. You don't have to do research. Let's say you were going to identify 20 companies and you were going to build your own portfolio. Boy, that's a lot of work because you got to research all those companies. You got to make sure that you're not surprised. So the nice thing is it's passive, as I said earlier. The bad thing is, I don't think there's ever been a year where an index fund was up 10 times what it was at the start of the year. But you know what? That happens with individual stocks. So the downside is you're limiting your upside with index funds. You're not going to get that kind of return. And so you're diluting your returns, and you might be, let's say you end up having 7 different index funds. You can very quickly end up with what I call diversification, not diversification, but diversification. So you're actually over-diversified. On the other hand, you don't want to be under-diversified because, as I said earlier, the S&P 500 for the last decade's done pretty well. But does that mean over the next 10 years it's going to do well? Maybe large cap growth falls out of favor. Maybe small cap value starts taking off. And then are you going to hold on to the S&P 500? So simply putting your money in the S&P 500, that sounds simple, that sounds easy to do, but in practice, it's not as simple. If you went 3, 4, 5 years and the S&P 500 dramatically underperformed other indices, are you going to be tempted to switch? And if you do switch, is that going to be the exact moment that the S&P 500 starts doing well again? So it's not as simple as it sounds. Okay, enough on index funds. Let's talk about real estate. And at the end, I'll kind of assimilate everything together and share some thoughts on what this might mean for you. Okay. Let's look at real estate. So one of the biggest things with real estate is, for most of us, we buy real estate with leverage. We don't think of that. We think of it as, well, I put 20% down, I put 30% down on a property, and I buy either my home or I buy a rental property. And the rest, of course, we use debt, right? I mean, I know very few people. As we get older, it becomes more common, but very few people in their 30s or 40s that can pay cash for an entire home or an apartment complex. So you put down 10, 20, 30%, maybe 40%, and the rest is funded with debt. Well, that's called leverage, right? If you put down 30, let's say 33%, and you borrow the other 67%, that's 2 to 1 leverage. That's not a small amount of leverage, but if you did that with stocks, I'd say you're crazy. Don't do that, right? That's called buying on margin. And that's a quick way to get your butt handed to you in the stock market. Well, you know what? It's a quick way to get your butt handed to you in real estate too, if you over leverage yourself, because every city, every investment goes through cycles. And maybe you buy an apartment complex, but for whatever reason, people start moving out of the town that apartment complex is in. And now all of a sudden, you still owe the bank a set amount of money every month, but you don't have the same rents coming in. And that might never have happened for 20 or 30 years, but it doesn't mean it can't happen. So leverage is nice when things are working, but leverage can bite you when things aren't working. In fact, I'll let you inside of the tent. I work with a lot of attorneys. I'm not an attorney. I should say this is not financial advice. I don't know your situation, but a lot of real estate attorneys have 2 practice areas of expertise, practice expertise. They're real estate attorneys, and can you guess what their other area of practice expertise is? Bankruptcy. And the reason is, when real estate's doing really well, they focus on the real estate. And then when things get ugly in real estate, they focus on the bankruptcy side of their business. So that shows you just the dynamics in real estate. So be careful. The other thing in real estate is you got to know what you're doing, right? It can take a lot of research to do real estate. And getting the right location and avoiding surprises. And the real estate agents, they're salespeople. Their job is to sell you a property. So you have to do your own research. Just don't take what the realtor's telling you. Oh, this property's done this well, and the previous owner is just killing it. Well, maybe they are killing it, but in part because of the price they're selling it to you at. So even when you have a representative who's representing you, just, most real estate agents don't get paid unless you buy something. So they may have that fiduciary duty to you But it's really hard to avoid that bias where if the deal doesn't close, they don't get paid. So enough said on that. A positive for real estate is what I have seen being a financial advisor for over 20 years. When I look at people that have built up their net worth, let's say by being a physician, or they've built up their net worth by being a business owner, or they've built up their net worth by real estate. And these are just three of the common areas that people built up net worth. What I see is, boy, like business owners and physicians, you can just tell they're wicked smart. They graduated in the top 10% of their high school class, and they just kept going from an academic standpoint and just in a life standpoint. They've always been in the top 10%. What I see on the real estate side is a broader group of people that can succeed. And I think that's a good thing. Real estate, it's really about making great decisions when you make the investment. But from an operating standpoint, it's usually not as complex as maybe a business would be. So I think that's a good thing. I think there's a broader swath of people that if they choose wisely and if they do their research, a broader swath of people can succeed in real estate than maybe in running an operating company. Remember, 80% of all startups fail. And I would say it's not 80% of all real estate investors fail. So I think because it's not as operationally challenging, that more people can succeed with real estate. And that might be one of the biggest benefits of the real estate is more people can succeed. It doesn't mean you're going to succeed. The other thing on real estate I want to mention is it's typically not as passive as people think going in it's going to be. In fact, in my industry where I'm really helping people prepare for and transition into retirement, it's not uncommon for me to work with somebody that has spent 20, 30, or 40 years building up their real estate empire. But now they're like, Azul, I'm tired. I don't want to replace water heaters on the weekend anymore. I don't want to chase tenants that aren't paying their rent. I don't want to get that call at 2 a.m. that, there's one of the pipes burst. It froze overnight and there's a flood and now I've got a big problem, right? They just don't want that. They want to go from actively making their money to passively making their money. So while real estate can be passive, it's typically not as passive as people think. All right, so let's put all this together. What's the best route to go? It depends on you. It depends on what your skill set is. It depends on what your risk level is. If you really want passive, I think investing in the stock market can be more passive. Are index funds the right thing for you to do? I don't know. Personally, for me, I want a portfolio that's designed to meet my long-term objectives and that takes as little risk as possible. So I'm happy to pay somebody that's willing to do the research and spend the time to, if there's a company out there that I should own, I want to own that company. I'm happy to pay somebody for it. Not because I think they're going to beat the S&P 500, but because I think they're going to build a portfolio that's going to help me achieve my goals. So that's what I think about index investing is oftentimes I think, and admittedly I'm biased, I'm a financial advisor. I think there's a lot of value in having the asset allocation, the right amount of stocks, the right amount of bonds, that when scary things happen in the stock market, and think about it, they tend to happen a lot more frequently than people think, right? So we had the dot-com bubble bust at the end of the 90s. Then we had the financial crisis, which happened 2007, 8, and early 2009. And then 12, 13 years later, we had COVID, right? And those were three scary things. So my experience has been scary things happen more often than we think they're going to happen, and certainly like within 10-year cycles. So do I just want to own a black box that is an exchange-traded fund? That can be hard when that black box, like during COVID, if you had the S&P 500 index, that black box was down 20% in 3 weeks. That ticker symbol for the S&P 500, you're like, what's going on? Well, what was going on was people were wondering, are we going to go into a depression? I think it's easier to stay the course when you can say, here's some companies that I own, and these companies are actually going to benefit by what's happening. Think about some technology companies when COVID happened. We all had to work from home, and maybe you had an older laptop, so you had to buy some technology. Maybe you needed to buy some software services. So you could look at what you own and say, yes, this investment is down 20%. But you know what? As horrible as COVID is, I really see this as a benefit for them. It's a tailwind for them. It's not a headwind. So I'm not going to sell. But when you just have a black box that drops 20% over a 3-week period, you're like, I don't want anything to do with that black box. So that's my thoughts on index funds. Real estate, if you're a long-term investor, if you're willing to research it, if you're willing to be patient and wait for the right property, I think can make a lot of sense for people. You're likely going to get paid a premium over an investment cycle, which in real estate I think is 10 to 20 years. It's not 2 to 3 years though. But over an investment cycle, you're likely going to, there's no guarantees, but you're likely going to be paid a premium versus the passive investing in the stock market, frankly, because you got to work for it, right? So for the right person, having some real estate can make sense. And that as you get educated in this, you will know not very quickly, but I think within 7 to 10 years, do you have a sense of the type of real estate investments that are going to do well over a period of time? And again, the world changes, and it changes pretty quickly. Think about the people that own office buildings. And now with stay-at-home, and people working from home, even though from a health standpoint, we don't have to, but we like to. So offices have more vacancies now. So as long as you can weather those kinds of storms, so you dip your toe in real estate, maybe this, again, is not financial advice. You see if it's something that you have a skill for, that you're making good decisions over a long period of time. And then maybe you buy your second or your third property. And this is where it all comes together and culminates, is look after several years of doing something. Not, did property values double in a city? Because I don't think anybody can predict that over a 3-year period. If you could, we'd all own the real estate, right? But look over several years, preferably a decade. I know that's a long period of time, but say, do I have the skills to pick out a good property? Do I know what the factors are that are going to lead to control? Do I know what the risks are? And then if you find yourself that you have this expertise in real estate, there's nothing wrong with that being a core part of your portfolio. But I would not go from 0 to 100 miles an hour in real estate, because the learning curve and the learning journey is done in steps of $10,000, $20,000, $50,000. So I would be careful. You're going to learn a lot buying that first piece of real estate. Let yourself learn that before you double down on another and another. And all of a sudden, if you find out, I'm not as good as I thought, now you've got a problem. So that's my thoughts on exchange-traded funds and real estate. I hope you found this helpful. If you did, remember the goal of all this, the goal of investing is to give you the life that you want. And that's why I want you to think about watching this video here, which is 5 reasons to retire as soon as you can. I'll see you in there. Thanks for watching this.